A $10,000 investment in NVIDIA in 2015 would be worth over $2 million today. But this isn't about the people who bought. It's about why nearly everyone else didn't, even when all the information was sitting right in front of them. NVIDIA makes specialized computer chips called graphics processing units. For most of its existence, that meant one market: video games. If you wanted realistic graphics in games, you needed a powerful GPU. NVIDIA dominated that space. To Wall Street, this made NVIDIA a decent but unremarkable technology company. Hardware businesses face constant competition. Profit margins get squeezed. Products become commoditized. The stock moved with gaming trends and product cycles. In 2015, shares traded around $20. The company was valued at roughly $12 billion. Profitable, established, but not the kind of business that typically generates life-changing returns. Most analysts saw a mature company in a mature market. What they missed was that NVIDIA's chips were already being used for something completely different, and that other use case was about to become far more valuable than gaming ever was. The story actually begins in research laboratories in the late 2000s. Scientists working on artificial intelligence had a computational problem. Training neural networks, the mathematical structures behind AI, required performing millions of calculations simultaneously. Traditional computer processors, CPUs, handled tasks one at a time. They were too slow for the scale of computation AI required. Researchers discovered something unexpected: graphics cards, designed to render millions of pixels in video games, could process these AI calculations much faster. GPUs performed thousands of operations in parallel. The architecture that's made explosions look realistic in games also made machine learning practical. This wasn't NVIDIA's strategy. It was an accidental fit between hardware designed for one purpose and a completely different need. But here's where the story gets interesting. Most companies would have treated this as a curiosity, a small side market. NVIDIA's leadership saw something else. In 2006, they released CUDA, a programming platform that made it easier for scientists and developers to use GPUs for non-graphics tasks. They invested heavily in tools, libraries, and support for researchers working on machine learning. This was a significant risk. The AI field had crashed multiple times before. In the 1970s, in the 1990s, waves of enthusiasm had turned into what researchers called AI winters, when progress stalled and funding dried up. Betting resources on AI in the 2000s meant believing this time would be different. The gaming business was reliable and profitable. Diverting engineering talent and money toward a speculative academic field with no clear commercial market was not an obvious move. Competitors like AMD and Intel stayed focused on established revenue streams. For several years, NVIDIA's AI bet looked more like an expensive experiment than a business strategy. Then, in 2012, a breakthrough happened. A team at the University of Toronto used NVIDIA GPUs to train a neural network that won an important computer vision competition by a massive margin. The approach, called deep learning, suddenly looked viable in ways it never had before. Tech companies noticed. Google, Facebook, Amazon, Microsoft all started investing in AI research. Every one of them needed serious computing power. Every one of them turned to NVIDIA. But here's the remarkable part. Even as this was happening, most investors didn't catch on. The stock moved modestly. Analysts still modeled NVIDIA primarily around gaming console cycles and GPU refresh schedules. The AI revenue was growing, but it was buried in financial statements under data center sales. It wasn't broken out clearly. You had to read earnings transcripts carefully and understand what accelerated computing meant to see what was building. By 2016, data center revenue had become meaningful. By 2018, it was approaching gaming revenue in size. Yet the market still valued NVIDIA mostly as a gaming company with some enterprise sales. Then something happened that created enormous confusion: the cryptocurrency boom. In 2017, people mining Bitcoin and Ethereum realized that GPUs were also excellent for solving the cryptographic puzzles that generate cryptocurrency. Demand for graphics cards went wild. Prices spiked. NVIDIA's sales surged. The stock more than tripled in 2 years. But the gains were driven by the wrong narrative. Investors piled in thinking NVIDIA was a crypto play. When the crypto market crashed in 2018, NVIDIA's stock collapsed with it. Shares fell nearly 50% in a matter of months. Excess inventory piled up. Sentiment turned sharply negative. The story became NVIDIA got caught up in a speculative bubble. This moment was critical. It was also completely misleading. The crypto business evaporated, but the AI business kept growing. Data centers kept buying chips. Cloud providers kept expanding infrastructure. The fundamental demand for machine learning wasn't affected at all. Most investors saw the price crash and assumed the thesis was broken. They sold. What they failed to recognize was that two completely different businesses were operating inside the same company, and only one of them was collapsing. Smart institutional investors who understood the distinction did the opposite. They accumulated shares while the market was panicking about crypto. They separated noise from signal. Between 2019 and 2022, NVIDIA's AI business continued scaling. The stock recovered but didn't explode. It was profitable, growing steadily, but still not widely understood as the foundational infrastructure for artificial intelligence. Then, in late 2022, OpenAI released ChatGPT to the public. Within weeks, tens of millions of people used it. For the first time, AI went from abstract to tangible. Suddenly, every company needed an AI strategy. And every AI strategy required enormous amounts of computing power to train and run these models. The market suddenly understood what had been true for years. NVIDIA wasn't just benefiting from AI. They were the essential infrastructure provider. There was no viable alternative. Training large language models required thousands of GPUs. Every tech giant was competing to build bigger models. The stock went vertical. In 2023 alone, it rose over 200%. NVIDIA became one of the most valuable companies in the world. But by this point, the major opportunity had already passed. The insight had become consensus. Why did so many people miss this for so long? The first issue was mental categorization. NVIDIA had been a gaming company for 20 years. When people looked at it, they saw a hardware company in a competitive market. Even when the business changed, perception lagged reality by years. Investors anchored to old mental models and never updated them. Second, the information was technical. Understanding why GPUs mattered for I required some effort. It meant reading beyond financial headlines. Most people weren't willing to do that work. When an investment requires technical understanding, the majority of investors simply move on to something easier. Third, the crypto boom and bust created confusion. Many investors thought NVIDIA's growth was speculation-driven rather than fundamental. When crypto crashed, they assumed the entire growth story was fake. They didn't separate the temporary tailwind from the permanent shift. Smart investors did something different. They ignored short-term narratives and focused on a simple question. What are customers actually buying and why? They saw data center revenue growing every quarter. They saw every major tech company prioritizing AI. They saw NVIDIA's technological lead widening, not shrinking. One specific mistake retail investors made was waiting for confirmation. They wanted proof that AI was real, sustainable, and not another bubble. They wanted experts to validate it. They wanted the stock to stabilize. By the time all that confirmation arrived, most of the returns were already captured. They traded certainty for opportunity. There's a cognitive pattern here worth understanding. People are far more comfortable buying after something has already succeeded than before. Rising prices feel safer than flat prices. But in markets, safety and opportunity usually move in opposite directions. The moment everyone agrees something is a good investment is often the moment it stops being one. Another factor was narrative distraction. The story kept changing. Gaming company, crypto beneficiary, data center play, AI infrastructure. Each narrative shift made people question whether the previous story was wrong. But investors who looked past narratives and focused on actual product demand saw consistency beneath the surface. The mental model that mattered was distinguishing between durable competitive advantages and temporary tailwinds. Crypto mining was temporary. It could disappear overnight and did. AI infrastructure was durable. It solved real problems and got more valuable as models got bigger. One was speculative. The other was structural. Several principles emerged clearly from this case. First, the biggest opportunities often hide in plain sight. NVIDIA's transformation was documented in earnings reports, conference presentations, and industry publications. None of it was secret, but it required reading primary sources and thinking independently. Most investors outsource their thinking to analysts and headlines. The few who do their own research find what others miss. Second, business model transitions create mispricing. When a company shifts from one market to another, valuation models break. Analysts keep using old frameworks because they're comfortable and established. This creates a window where the business has changed, but the market hasn't noticed. That window is where opportunities live. Third, temporary volatility often obscures permanent trends. The crypto crash had nothing to do with AI, but it tanked the stock anyway. Investors who could separate the two made tremendous returns. Those who couldn't sat on the sidelines. Learning to identify which forces are permanent and which are temporary is one of the most valuable analytical skills. Fourth, competitive moats matter more than growth rates. NVIDIA didn't just benefit from AI. They built software ecosystems, developer relationships, and technical advantages that made switching costs prohibitively high. Customers weren't just buying chips. They were locked into an entire platform. That's what made the return sustainable rather than fleeting. Fifth, insight requires work. The people who found NVIDIA early weren't lucky. They were reading technical papers, tracking cloud infrastructure spending, talking to developers, and paying attention to what researchers were using. They invested time in understanding the details. That effort created an informational edge. Fifth, insight requires work. The people who found NVIDIA early weren't lucky. They were reading technical papers, tracking cloud infrastructure spending, talking to developers, and paying attention to what researchers were using. They invested time in understanding the details. That effort created an informational edge.